The growth numbers look impressive on the surface, but there are always buts. Growth of 0.9% for the March quarter is good. If we keep that up, the Reserve Bank will be raising interest rates this year. Most of the growth came from the trade performance. That's a good thing. Don't bother with a magnifying glass for domestic final demand because it's zero. It represents household spending and housing as well as investment. It's zero because the pickup in household spending and housing was wiped out by the fall in investment. That is, mining investment. Then there was a pretty big build-up in inventories, which can be good or bad. If businesses are building up stocks because they're confident about the future, that's good. If the build-up is involuntary, that's bad. And let's not forget the Reserve Bank was cutting rates during the March quarter, so things didn't look great to them. In fact, over the past 13 years, the Australian economy has been struggling to reach trend, or what we think is average growth. So history tells us that this result is the exception rather than the rule. Or maybe the average isn't the average anymore. They weren't celebrating on the share market, where investors are shifting money into US and European bonds. High-yielding stocks like the banks took the brunt of the selling. The losses would have been worse if not for a pickup in iron ore prices, which helped some of the miners. But the currency that the Reserve Bank would like to see lower went higher. Those stronger-than-expected GDP numbers reinforce perceptions that interest rates won't be cut again. And that's finance.